What I want to do is go over what is equity banking first, and then how can I use private equity banking in my life. Um, Pretty bold statement here that I like to make. Many people fail to realize they have the power to control their financial landscape. How many of you knew that the movie or the book, The Wizard of Oz, was about banking?
Hmm?
Yeah, Christina's like,
I've never
what?
heard that.
You'd
I've
never
never
heard
heard
that
that before.
before. Yeah, it's
Never.
about banking. The Wizard of Oz was this magical banker in the background, and the whole idea of this was that we had the ability to take over our own financial world. That's what that movie was about. And the guy behind the curtain, all of that was about banking. And so I got this statement here: mastering your financial condition through private equity banking is the most lucrative endeavor you can pursue throughout your life and for generations to come. I know it's a pretty bold statement, but I think that after you watch this, you'll get a better idea and you'll see that that's pretty accurate. Private equity banking is about recapturing the interest you pay banks for the major items you purchased during your lives. Um, Private equity banking, though, is not involved in any form of investment, but instead how you finance the things of your life, which can include investments. So, what is private equity banking? This gentleman here, Ed Slott, he had a program out a couple years back called Retire Safe and Secure. He's a CPA, and he stated this in this program. He said that private equity banking is the biggest single benefit in the tax code. Here's what we get out of it. Now, the IRS calls private equity banking, that's my term for it, by the way. That's just what I call it. But the IRS calls this a cash accumulation contract. And so here's some of the features. With a cash accumulation contract, all of the monies that you put in are tax free. They grow tax free, and you have access to them tax free throughout your life, which again is why Ed Slott says it's the best thing in the tax code. Two, you get guaranteed returns with zero market risk. Anybody out there shoving their money into something that there's zero risk at and guaranteed returns? Okay.
Like
What was that?
money market?
Yeah. Not much out there. Okay, money market. But is it guaranteed? Because it's risky. If it's in the money market, it moves up and down, right?
Mm.
Market being the key word means risk. So you get liquid cash, so there's no age restrictions, no funding caps. And then okay, you get certain protections with a private equity banking account from creditors, lawsuits, and an unpredictable economy. We get compounded interest. Everybody here as a loan officer understands what that is, both on the money that you deposit as well as any dividends that you get in the account. And then here's the real kicker. It's arbitrage, being able to use your money twice simultaneously. That sounds like oh my gosh, that sounds crazy. It is. I'll explain it here in just a second. So first, though, I want to clarify some banking functions because I want to make sure we understand what I'm talking about here. I'm talking about the banking functions here of money, or the functions of money. One, the banking function. So we put money into a warehouse or we borrow money. That's what I call the banking function. And when I've got my money in a bank, I want it to be safe. I don't want there to be any risk. I don't want to have to pay taxes on it if I don't have to. I want anytime access, and I want guaranteed growth. The other functions of money are investing, where I want to put my money at risk. Christina, that would be what I would call a money market because it's at risk, and I expect it to grow, which is fine. And then spend our money, and the traditional thought process is anytime I've spent my money, I've had a lost opportunity cost. So when I get rid of my precious capital, it's gone, and that's it. But I'm going to show you a better way today. Now, I draw a line between there because I really believe that what we're talking about today, in my mind, is all warehousing and borrowing of money. Gentleman that wrote a really cool book called The Pirates of Manhattan. If you want to understand Wall Street, that's a great book. In there, he says, money must reside somewhere. Yeah. When viewed in this light of all alternatives, permanent cash value life insurance is perhaps the safest and most economically efficient holding tank of cash savings within America today. Now, don't everybody hang up on me right now because you heard the word cash value life insurance, okay? That was the stickler word for Mike Cordes also. He was like, I don't like life insurance. I said, I don't either. But this is something special. It's very different. And again, that's why it gets those special privileges that other things don't get. About in 2017, at the time, Janet Yellen was the head of the Fed. Now she's the Secretary of the Treasury. But back then she said, I don't believe we'll see another financial crisis in our lifetime. Anybody on this call want to bet me a Coke and a Snickers bar that that's not correct?
I don't think she has our best interest at heart, actually.
Okay, I'm with you, William. In fact, I pulled this off of the FDIC's website today about failed banks. We had Citizens Bank last week. We had Heartland back in July. We had First Republican Bank in May. We had Signature Bank on March 12th. And we had Silicon Valley Bank on March 10th. Now, I'm going to ask an obvious question. I don't want to ever sound condescending, especially to this group of loan officers. But I want to ask a simple question. Back in 1929 through 1933, when we had a run on the banks, what did you have to do to get your money out of a bank?
Rob it? I'm kidding.
I think they were doing the robbing, Christina, but okay, I'll go with that. But you had, okay, so if you were a bank robber, how did you go get the money?
Well, I mean, I can be practical. I say, with a gun, but I don't know where. I'm not following where you're
You
going
just
with
ask for it. You just ask for it, right?
You had to actually go into the bank itself and stick your gun in their face, right, Christina? That's what I was getting at. It was so obvious that you guys weren't getting it. But when you had, back then, we had to actually walk into a bank to get our money. Well, we all know what happened on March 9th. Does anybody know how many tweets or X's or whatever they're called now went out on Twitter on the morning or the day of March 9th?
Mm-mm.
About 8 million. Now, how long did that kind of news? What happened was one of the venture capitalists that fed their clients over to Silicon Valley Bank said they weren't so sure about, they weren't I don't know how to word it properly, but they just said, we don't have a lot of confidence in Silicon Valley Bank anymore. And that word spread through like wildfire through Twitter and WhatsApp. And within 4 hours, Silicon Valley Bank had $42 billion in withdrawals.
Wow.
Think about that. Big difference in standing in line waiting to get your money, right? One banknote at a time. So this is what I'm talking about today, is banking with an insurance company instead of banking with a bank. Okay? So again, back to the statement I said in the very beginning, many people fail to realize they have the power to control their financial landscape. And here's how this works. When a bank, when NEXA deposits your money from a commission into Wells Fargo or Citi or Bank of America or your local credit union, who owns that money, folks?
They do.
Exactly. And the courts have shown that time and time again. When you deposit your money into the bank, you become a bank's creditor. And how far down on the list of importance are you?
So, Eric, to your last slide, but aren't you FDIC insured, or is that just kind of a misnomer?
Nope.
Or
banks are not, or insurance companies are not FDIC insured. But here's the thing, that they are much safer than a traditional bank, and that's why I'm going into this in depth. So keep asking those questions, Christina.
Okay.
Did I answer that? But no, insurance companies are not FDIC insured.
When they pulled all the money off of Silicon Valley banks, were they not insured, the depositors that pulled all their cash, or anybody who was left over?
Right. So, all right. Remember who Silicon Valley Bank was gearing their money toward? Because how much do you get? How much is FDIC insurance right now? We can Google that.
Oh, it's 250,000. It's not
250 now. Okay, yeah. So it's 250. My best friend works for a company that has had their accounts with Silicon Valley Bank, and they were a startup company. So when they got funded with millions and millions, or tens of millions, or hundreds of millions of dollars, right? And so that's how much money was sitting in a Silicon Valley Bank under the name of whatever company that was. So when they went under, it wasn't this guy right here with his cell phone who had $85 in a savings account and $85,000 in a checking account or whatever that was worried about it. They were talking about the customers of these venture capitalists, and they were only going to be insured up to $250,000, yet they had millions in there.
Got it. Makes sense now. Okay.
Okay. Yeah. Good. No, very good point to bring up. So back to banks. When you put your money into a bank, you are one of their creditors. So if new company in Silicon Valley shoves their money in there because they raised 100 million in capital when they went public, and that money's sitting in that bank account. That whole thing is at risk, less 250,000. That's the problem. And then, but with a mutual company, as an insurance company, who owns that money?
I'm going to go with you do.
Yes.
The policy.
Exactly. Because the policy holders are the stockholders. There is no stock in a mutual based company. That's what it means by mutual company, is that there are no stockholders. It's us. Again, we are reclaiming our banking capabilities, trusting an institution to help us, but we are the owners. And so that's a huge difference in the executives at a bank or an insurance company that isn't a mutual company. If it's stock-based, it's the same problem. A stock-based company, the executives have to, their fiduciary responsibility is to who?
There's
The stockholders, really.
Exactly. The stockholders. But in a mutually held insurance company, the fiduciary responsibility of all those executives is to whom? And we've already said it.
To the owners.
Exactly.
The owners.
You and I, the policy holders, right? So there's a lot of risk they don't take in an insurance company environment. Banks pay out a little tiny bit. Insurance companies pay a lot. I go more in depth on some of this stuff over here, and we've already talked through a lot of these points. Remember back in 2008, just to kind of get to the question that Christina was asking, but isn't this insured? No, it is not. But here's what happened in 2008. Stock-based insurance companies and stock-based banks, this is what Forbes had to say. With their survival on the line, publicly traded insurers, stock-based insurers, are scrambling for cash by cutting dividends and issuing new shares, thus diluting existing investors, begging regulators for a relaxation of capital requirements and lobbying Washington for a cut of the $700 billion Wall Street bailout. And then it says, while they're mutually owned, so the mutual companies that were insurance companies, rivals haven't asked for a dime. Their statutory surpluses, and that's the key term there, have held steady. Some are announcing plans to pay out near-record dividends to policy holders. So these guys were ready to pay out near-record dividends. These guys were asking for bailouts. So the question then becomes, what are statutory surpluses in a mutually held insurance company? Does anybody know that? I'm just asking. I doubt it. I'll explain it in a second.
Mm-mm.
Okay, in a bank, and I don't want to get into a class on fiat currency and how banks work, but basically, I think we know this. Anytime we generate a loan for somebody, Christina, let's say you generate a loan for somebody for a new home for $300,000. How much did the bank have to have on hand to create $300,000?
I mean, they had to have that line of credit with much more than that to extend that. What?
You would think that's the correct answer. That's not how it works. Our banks, when you create a loan, a $300,000 loan, the bank only had to have $30,000 in Tier 1 capital. That means you just created out of nothing $270,000. Yeah. Now, and you can go online. I would suggest anybody that doesn't understand that, please go online and look up, the banking system, the monetary system. There's a lot of good videos out there that'll explain how it works. But here on statutory surpluses for an insurance company, since it's still insurance and it's still tied to a death benefit, let me give you my own scenario. I have about $200,000 in cash value in my insurance policy right now, but I'm worth about $1.2 million. If I were to pass away, my wife would get a death benefit of 1.2. Which of those two numbers do you think is the statutory surplus that an insurance company has to keep on hand? The $200,000 that I have in cash value, or the 1.2 million they'd have to pay out if I get in an accident tonight?
I'm going to assume you mean the 1.2.
Yes, exactly. Yeah, big difference, isn't it, Christina? Than the $30,000 they need to be able to loan $300,000. Here, they have to keep on hand the total death benefit available. Isn't that amazing? That's how come these guys are so much more solvent. And just one more tidbit, not that it matters, but most banks, and I've got another presentation where I go over this, most banks have about 25 to 40% of their Tier 1 capital in high cash value insurance policies. And I've got a video out there on my website that goes over that. Okay. Just some more quick things. Obviously, who decides if somebody qualifies? We're all loan officers. You guys understand that. If you want to borrow money from the borrowing side of it, and you go to a bank, the bank decides whether or not we qualify. Here, if you've got the money there, you qualify. There is no qualifying. You just ask for it and it comes back. Now, being an insurance policy, and I don't know where to put all this stuff, so I had to throw this in here. Here's one of the drawbacks to using an insurance company as your bank, and that's that you still have to have a human body there that's being insured. And there are three parts to this. There's the owner of the policy. This is the person or entity, because it can be a trust or something like that, that owns the policy. They pay for the policy. They have access to all the cash value during the lifetime of the insured. Then you've got the insured. This is the person that's being insured, the human body. And then you've got the beneficiary. And again, that can be individuals, that can be a trust. And this is how these huge family net worths continue to get pushed on, because the owners of like, say, the Rockefeller family or the Kennedy family and people like that, the owner of the policy is really a family trust, and the beneficiary is also a family trust. And then the members of the family are insured and they can borrow money against it. But that's how they've preserved generational wealth for years and years and generations. Okay. Any questions so far? I know we've talked about something that's most people have a grasp of it. If not, there are many good videos out there on how banking works versus insurance. But so how can we use, please go ahead.
Oh, I said, I'm good. Go on.
Okay. So how can private equity banking be used? So back to this part. It's the spending. It's the lost opportunity cost, or this arbitrage, that makes this unique. Private equity banking does not involve any investment, but instead how you finance the things of life. Now, they say that the library in hell is filled with math story problems. So here's your math story problem, so you think you're in hell today. And I'd like an answer from most of you, if you would, please. If your money is sitting in a bank account earning 4%, does it make sense to borrow at 6.5? Marcella's shaking her head no. William?
Well, so I'm thinking if I'm earning 4 and I'm borrowing at 6.5, it's actually costing me 2.5 over what I'm making.
Okay, so does it make sense?
That might make sense if I needed the money.
Okay. 2 is better than 6.5. That's true. Okay. Anybody else? What do you think, Jim? You got a furrowed brow like you're thinking about it.
You know, there's tax advantages, and you can write off interest for taking loans. And I personally would rather have my money liquid and rather than tie it up. So I would take the 6.5% loan and leave my money in the bank at 4%.
All right, I'm going to play with you today, Jim. So let's go with this. Good answer. So let's say we want to buy a car for $30,000. I can pay cash, right? That's the traditional way. I've saved up my money. But Jim just said, wait a minute, I still want to have cash on hand, so I don't want to tie up my money. I'll just go get a loan. So I can borrow at 6.5, let's say, for 5 years. You can tell I did this a couple years ago, but it'd probably be 7 or 8.5 now for a car over 5 years. But the point is here, this is how we've been taught to buy things. We save up our cash, then we spend it, we buy that car, and we go back down to zero. Or we borrow money, and then we go back down to zero. But most people don't talk about doing both simultaneously. So let's walk through this. Pay cash. My money's gone. So let me ask a question. If I pay cash for a car today for $30,000, how much has that $30,000 grown in my bank account over the next 5 years?
Well, you spend it all, so it's not there.
Exactly. Trick question. Thank you for the answer. Zero. All right. So, but here's option number 2. Borrow $30,000 and leave the cash in the bank, which is what Jim said. So my savings account is at 4%. So my $30,000 in the first year has grown to $31,222. And what I've borrowed, I'm paying down on at 6.5. So I only owe $24,752 at the end of the first year. Everybody with me?
Mm-hmm.
Okay. Second year, my savings has grown to $32,000, and I've paid down on that loan to $19,000. Year 3, my savings has grown to $33,000, and I've paid down that loan to $13,000. Year 4, my savings has grown to $35,000, and I've paid down to $6,800. And in the 5th year, my money has grown to $36,629, and I've paid off that loan. So if we look at the difference there, the amount I've earned is $6,629 in interest at 4%, and I've paid $5,219. My net gain, $1,411. So Jim was right. Now, I did this a couple weeks ago, and I said, so by doing both simultaneously, if I'm using my savings as collateral, which is what you can do with these insurance company policies, I'm doing both at the same time. Now, I did this, and a gentleman that was on this call, he was off mute, and he just said, oh, $1,400, big deal. And that bothered me because I didn't know how to answer that day. So the next day I was out jogging, and I decided to come home and build this spreadsheet. So I apologize that I built a spreadsheet as an answer, but let's walk through that same concept. So if I finance the car, we just saw that over 5 years it cost me $35,000. Any loan officer not get that? You shouldn't be a loan officer, right? All right. Then, but here's how it works if you're inside of an insurance policy. Over 5 years, we just said my money, my cash value continues to grow, and it grows to $36,630. The reason for that is that the insurance, when you borrow $30,000 from an insurance company, you're not. Let me repeat that. You are not borrowing it from your own account. You're borrowing it from the general fund of the insurance company. And so over here, we're showing the same numbers, paying out at 6.5%. And so again, the 5,219. And so the difference, they paid for that car at 28,500. Okay, so we can understand that that was a cheaper car. We get one for 28, same car for 35 if we financed it. Now the trick question, if we had paid cash, how much did we really pay?
That's the money over 5 years.
Exactly, the cost of money over 5 years. Thank you so much, Christina, because that car cost them $6,600. But I just made a comment that this money stayed in that account. So what happens if the person buying that car, and that was where I was stuck in my thinking a couple weeks ago, Christina, was, well, it's 5 years, but it really isn't. If this person that bought a car 5 years ago actually lives 10 years, what's happened to the cost of that money that stayed in that account? It's now worth $14,724 more. If they live 15 years, it's now worth $24,600 more. If they live 20 years, it's now worth $36,666 more. So this is just a new paradigm on how to purchase stuff. So what I call private equity banking is a safe banking alternative. It's IRS sanctioned savings account. It's provided by some mutual insurance companies, and they offer tax-free growth, guaranteed returns, liquidity, the thing that Jim mentioned, unique economic and risk protection, compound interest, and arbitrage. So let me go back to that statement I said in the very beginning that sounded so powerful, but mastering the control of the interest you pay or don't pay is the most lucrative endeavor you can pursue throughout your life and for generations to come. We have the power, just like Dorothy, to click our heels and turn our own finances on its head and quit depending on banks for financing. So how do most people use it? So let me ask this question. How much of your financial security depends on people, companies, economic situations you can neither predict nor control?
Wow.
And I don't have the answer to that question for any of you individually, but I do know that collectively I do believe that all of us should have at least a portion of our income or a portion of our financial security tied up in something that's more secure than the banks. Okay, so as I've already said, this is not investing. I see it as a toolkit. And getting out of debt and staying out of debt with a debt action plan is usually where I begin with most people. Now, some people are already out of debt and they can go straight to the wealth building side of things. But as what I just showed you a minute ago is how to pay off a structured loan with a non-structured loan and how to get out of debt and simultaneously build wealth. So let me go through that. Here's some of the things that you can use this for. Never go to zero paying cash. We just saw how to do that. You use your money twice simultaneously. You can invest in real estate with higher rates of return and less risk. That was the video that Mike watched on my website that got him interested. Protect business assets from unpredictable events. You can outperform the stock market with zero risk, invest in new business with higher rates of return and less risk, build a predetermined tax-free retirement income. I'll show you a spreadsheet that I use to help people determine that, and then leave a predetermined tax-free legacy. And this, again, these last two are how ultra wealthy families continue to preserve their wealth, and I can teach you how to do that. But let's talk about debt elimination first. Why debt elimination? Obviously, during COVID, America has soared to the most debt out there. We now have student loans at $1.7 trillion, auto loans at $1.5 trillion, credit cards are at 1.2, and mortgage debt is at $12 trillion a quarter ago, 2 quarters ago now. So again, this begs the question. If I could show you how to eliminate all your debt in 6 to 9 years without spending any more, would that be a help?
Absolutely.
Loan officers, if I could help your clients eliminate their debts in 6 to 9 years, would that help you as a loan officer?
Mm-hmm. Yeah.
Yeah, and that's why Mike asked me to do this. So let's look at the average American family. Why focus on debt first? The average American household, for every $1,000 that they bring in, spends about 40% of that, or $400 of every $1,000 on taxes, about 23% or $230 on lifestyle, about $340 or 34% on debt service. And I know most of us are thinking, wait a minute, how come all my clients are at 50% DTI? but really the average in America is 34%. And then the average American only saves about $30 of every $1,000 they put away. And by the way, it doesn't matter if you're a doctor out there making, $25,000 a month, or you're a school teacher making $5,000 a month. How we spend that $1,000 we bring through the household is about the same for everybody. So if we look at the average American household making about $87,000 right now, 34% of that would be almost $30,000. So here's my question. How would $30,000 in extra annual liquidity help the average American family?
That'd be pretty large. Pretty large, pretty big impact.
Loan officers, can you see how a program like this can help your clients? I'll show you how it's done. And again, these were the words of Mike to me. He said, look, if you can help people eliminate your debt, we like to kid ourselves, he said, that what we do is not transactional, that people will remember us, that 8 years from now when they go to get their next mortgage, they're going to go, oh, I remember that Jim guy. I remember Christina. She was great. I remember Bill. He was wonderful. And they're going to come back to you. But the reality is it's a transactional business that we're in. But he said, if you can help your clients, if we can have our loan officers help them get their clients out of debt, that becomes a transformational thing. And especially if they tie that getting out of debt to the loan officer. And so that's what I try to do. I have this program. This is a real couple. They've given me permission to use it because I've only put their first names. But Matthew and Mariah are in the military and they have 2 houses. So what I do is I walk through this process. What you're looking at is a software screen that I have. And so I put down the name of their houses, fixed terms. I put the principal down there, right? I put their interest rate, 3.65, put their monthly payment, any overpayments that they've got. Now, this is an amazing thing. I know most of us as loan officers have seen it, but I can go right here and click on View Amortization, and it'll show me this. Here's the thing that most people don't understand. That couple thinks they're paying 3.65, but the reality is in the first month they're paying 65.72% interest. In fact, they don't get all the way down to 3.65 until the 342nd payment, which is in the 28th year and 6th month. That's when they finally go below 3.65. So that's why this helps people accelerate their debts by using their money twice. So then I walk through people's consumer debts. Again, I don't need to bore you with this, but you guys get all this information so you've got it at hand. We can put this in and run a scenario for your clients. So I get their credits. And one of the things I'm looking for here, because when I tell people I can help them get them out of debt without earning or spending any more than they're currently spending, what I really do is I'm looking for this stuff here, where like this couple, their minimum payment's $63, but their actual payment's $100. Right? So they've got almost $37 there a month that they're putting toward a credit card that we can redirect toward helping them get out of debt. And that's what I end up doing. So I walk through this with these folks. Then I look at their investments. These 2 are both in the military, so they got a TSP. For those that don't speak military, that's a 401k for the military. Hers has $18,000 in it. His has $12,000 in it. Their monthly contribution, she's been putting in about $250. He's putting in $200. And so that extra money they can begin putting into getting out of debt to help them get out of debt. And then up here, I get the totals. Now the totals, because I've got all their other information there. So here we go with their income. They're both the same rank in the military, so they're both making the same income, but they also have that rental property, and they're getting about $1,900 a month out of that. Now, this part here, out of their income, I don't usually ask people to put any money in because like I said, I'm telling people I can get them out of debt in 6 to 9 years without earning any extra money. And so I'm not trying to take this, but this couple understood the math and they were like, well, we'd like to both put in about $1,000 more a month into this to help us get out of debt, which is, by the way, the same thing that a lot of people do. This young man, he's 26. He wanted to be able to save to buy a car. That's why I did that scenario at 30,000. He wanted to be put in his money for 5 years and save to buy a car. That's how we figured this thing out for him. So he threw 5,000 of savings into this private equity banking account, and then he puts in 520 a month. And so this is his cash value that's available to him because some of it's still buying insurance, and that's listed over here. So at year 30 or year 5, he'll have that 30,000 to get a car. Now this is my actual one. The person that did this for me said, "Hey Eric, I'll help you get out of debt," and same spiel. And I said, "Okay." And he put it together and he said, "Well, you need to be putting in about 740 or 760. I don't remember what the exact number was. Somewhere in the mid sevens a month to get out of debt in about 8 years." And once I understood the math, which only took a little bit of time, and the reason I understood the math is because as a loan officer, I understood the CMG all-in-one loan. Have you guys seen that?
Yeah.
Okay, so that's really why I understood this concept, because I understood the concept of the CMG loan. And so I went back to the guy and I said, "I don't want a policy with only $700 a month in it. I want to be putting away about $9,000 a month." And he laughed. And he goes, "Slow down, cowboy. Let's take this one step at a time." So I ended up putting in 5,000. That's what I've been putting in. So I'm in my 4th year. Like I said, I've got 200,000 in cash value in my policy now, and I've got 1.7 million, almost 1.2 million in death benefit. So don't any of you that know my wife be calling her and trying to hook up a deal here, guys. All right, just showing you. All right, so after that, I go through people's insurance. This couple both have SGLI because they're in the military. Again, I don't need to bore you with all that stuff, but she's getting out of the military, so she's going to quit paying the $24 toward the SGLI. Her husband's planning on staying in, so he's going to keep his. And then what I do is I print out a report, and I show people what they currently are in debt for. So this couple here is going to be in debt if they make the payments like they're currently doing. They're going to be in debt for 29 years and 10 months, and they're going to pay $325,000 over those 29 years in interest. But if they jump on board with this program, they're going to get out of debt in 9 years and 8 months, and they're going to save nearly $200,000 in interest. Now, here's the part that I want to point out to you loan officers. You'll notice here that it shows a payoff date. 9/24/23, 10/24/23, 11/24/23, right? 7/24/24 is their car. Loan officers, if you've helped me, or you do this yourselves, because if you get an insurance license, you could do this yourself. But if you use me and we work together on this, you're going to have this report. So what are you going to do when, and I know this was built for this client, their actual clients, so they're in the past, but what do you think happens on August 24th? What's a good loan officer going to do? What's that?
Was it not count that liability? Is that
okay? You can, but if you've already gotten them a loan, right, and they're
I'm going to call them up.
You're going to call them up. Exactly, Will, and you're going to say, "Hey, congratulations, you get to pay off credit card number 3. And then a month later, you're going to call them up again. "Hey, congratulations, you get to pay off credit card number 1. And you'll note that I don't put what visas they are down there. I don't need that information, right? They'll know which one it is, right? And then you're going to call them up again in November. Now, loan officers, let's say that it's only taking, a year and a couple months, 1 year, to pay off 3 credit cards and a car. What's happened to their credit score at this point in about a year?
It would have gone up.
Yeah. So if you got them squeezed them into a program, a DPA program, because they were first-time home buyers and their credit was right on the limit, you give them another year and a half and you help them get rid of all their revolving debt, because you'll notice what they've got left is just a solar loan and their 2 homes, right? But if you get rid of their revolving debt within 2 years, what kind of loan can you get them into now? Their credit's going to go up. Could you see refinancing it, say, into a 25-year mortgage so that you save them time on the mortgage and get them a lower rate? This is why I think this is a great program for loan officers, because you can help your clients get out of debt and then utilize that. Okay, so that's kind of what I wanted to go over today. Let me show you one more thing, and we'll just open this up for questions. All right, I'm going to show you one. This guy and his wife are investors. They do house flipping, and so they've always got some cash sitting around. So we built this so that they could drop in $100,000 in the first year. And this is his it's showing his insurance. So this, I don't need to go into all the details on this, but what I do is I put in the cost of their insurance. I put in what their cash value is going to be available. They do have, this couple does have younger children, so they've got a policy on both of them, both for him and for her. Cost of insurance is cheaper on her, so they can shove that one full of more money because she's a bit younger and she's female. It's cheaper that way. But then I put together their combined amount of money. So this couple that already has the $200,000 sitting out there to do this with, because they're investors, they flip homes, right? I think most of us know at least one or two investors that do this. Well, this first year, this couple's throwing into the insurance side of it $206,000, and they've got 184 of it available to use for reinvesting, for pulling back out and investing in flips. And they've also then got themselves a $3.2 million death benefit, which is not.
So,
yes, please.
Sorry. So who sets up the terms and conditions for the repayment of the money that you're able to use?
Great question. So let's go back to, okay. Let me go here. Where's mine? Too many screens, not enough time. All right, let's go back to look at my policy. Okay, that's it right here from current slide. Okay, Christina, I have here available to me 200,000, right?
Mhm.
When Diane and I moved here to Texas about 2 years ago, we had 139. But right now we've got 200 because I've kept paying into this thing. When we first got here, we took 60,000 as a loan from the insurance company to pay back, or to borrow to use as a down payment for this house here. I literally have not made a single payment against that since then. That's why it's called a non-structured loan. Because what we do obviously are structured loans, and on the first of every month, everybody has to pay their mortgage, and if they haven't paid it by the 15th, they get, nasty notes, and if they haven't paid it by the 30th, then somebody files paperwork, and if they haven't paid it by the 90th day, they start foreclosure and all that other craziness, right? But there's no date upon which you need to make a repayment for an insurance loan. Why is that?
Why?
It's a good question. That's why I'm asking. Why?
Because it was so, all right, so you borrow this money from you borrow it from yourself.
But no, you're not borrowing it for yourself. I want to clarify that. You're using your cash value as collateral, but you're never borrowing your own money. You're borrowing it from the general fund of the insurance company.
I got it. They take it off your death benefit at the end.
Bingo. What is the risk?
I see.
Exactly. So if I were to get in that accident today and pass away, I owe them $60,000 plus 2 years worth of interest, and they would pull that all back out, and they would give Diane $1.178 million less whatever I owe currently on today's date. So what risk am I in borrowing their money?
You're no risk at all.
No risk at all. So now let's take that a step further, and thank you for that question, because that leads up to what I do for these other folks. Remember, we talked about retirement. So here's this couple that's currently using hundreds of thousands in and out all the time to fix and flip properties. That's what they do for a living. And so if they keep this thing until age 70, they will have put in 1.6 million. Now let's say that they wanted to start pulling out $120,000 a year. And by the way, remember that in the beginning I used an example of 6.5 is what you were paying on the loan, and 4 is what they were paying you. The company that I've got this couple into, they get paid 5.2 on everything they've got in their cash value account, and when they go to borrow, they pay 5.
Wow.
Thank you, Christina. A wow is exactly it. Okay,
Totally. Yeah.
we're all Nexans, right? We have available to us today, last time I checked, 220 or so lenders? Which of those
240, I think.
lenders gives hard money or signature loans and pays you 20 basis points to borrow?
Yeah, nobody. Like, that's not how they do business.
Exactly. That's not how they do business. But Christina asked a great question, and that's why we explained why they can afford to loan money. The interest they're getting paid is 5.2, and when they borrow at 5. So if they want to subsidize their income at age 70 with $120,000, they're going to borrow 120. What's the interest on that? 6,000. How much interest are they earning on the 2.6 million that they've got in their cash value account? 123. So what's the arbitrage for that year? A positive $117,000. How long can they do this? Well, if we were to scroll down, you'll see that it doesn't hit an end point until after these two are both 121 years old. So let's go to the next, let's just crank it up a bit and say 150,000. Now they can pull out 150,000 still until they're 121 years old. So let's just jump it up to 250 because I want it to break at some point. So now they can only pull money out until they're 93. So this couple, this is what is amazing, is they put in 1.6 million between this year when they started this policy and when they start pulling money out, 1.6 million, and they will be able to pull back out 5.7 million in cash and have a death benefit that's tax-free to their family, where 6.5. So again, they'll take out the part that they owed to the insurance company of the 5.75 million, leaving their family a tax-free death benefit of $774,000.
That's pretty impressive.
Isn't that amazing?
So Eric, they only put 1.6, right?
Yep.
Okay.
And here's the magic behind it, because I often get asked, well, because we've all heard, well, buy term and invest the rest. And we've all heard, well, let's get an IUL because it's out in the market. This is something that is unique to whole life. It's called reduced paid up. Only offered to whole life policies, lets the policy owner stop premium payments and maintain a fully paid policy with guaranteed death benefits. So at age 70, their guaranteed death benefit is 4.9. They never put in another penny the rest of their lives. In fact, they start borrowing out, in this example, $250,000 a year. And they take that $250,000 a year until they're 92 years old. So obviously we could go less than that, so it would last them until forever, but so it's probably somewhere around there, $225,000 a year. How much tax do they pay on that $225,000 that they borrow from the insurance company starting at age 70?
I think they don't pay anything.
Exactly.
Wow.
Because it's a loan. How much would they have to earn to net $225,000 at age 70 if they were paying taxes on it, like say pulling it out of a 401k or something like that? If they're in the 30% tax bracket, add 30% to 225,000, right?
Yeah, they pay whatever the tax rate is out of their 401k.
Exactly. But here you'll notice that there's no policy drag. There's no premiums, there's no taxes, and there's no management fees. Question.
Sign me up.
Sign me up. Well, send me up.
So like those It's just because I've heard this like 3 times, guys. So I don't know where you are, but like I learned by immersion. So I listened to Eric the first time when I was driving, and then he and I talked. And then this time I got to see the slides. I think this is probably, if you're interested in help, this is me, and I'll turn my camera on so you can see me. I know that the guys say you gotta have your camera on all the time, so let me turn my camera on. All right, I just think if you're really interested in not only helping your current customers, your past customers, and your future customers, like I'm gonna incorporate this into my business starting today, like not just for investors, but for regular everyday Americans, because I have been knocking around the investment financial management world for decades. This actually makes the most sense and is the most empowering approach to managing money that I think I've ever heard. That's just me. Sign me up.
It was for me too. I mean, like I said, when I first heard this, I went, "Oh my gosh!" And then I went to I said, "Hey, can I do this?" And the guy goes, "Well, do you have a life insurance license?" And I said, "Yeah," but I had it because I was working at AAA selling P&C, so I was selling property and casualty, but I had my life license, right? I wasn't using it, but I had it. And the guy said, "Well, if you want to learn how to do this, you can come to some training." So I flew out to Florida that like 2 weeks later after first introduced to this thing. And that's when I was sitting in there, we were already in the process of getting me a policy at 700 and whatever I said it was, 740 or 760. I honestly don't remember, but I remember going into the cafeteria at lunch that day and saying to the guy, "Hey, I want to put in 9,000 a month." And he said, "Slow down, cowboy." But that's the thing. I understood the math.